Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come on to that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes.
The clock is ticking on the global financial system. Trillions in debt are about to be refinanced, and the only path forward seems to be lower interest rates and more money printing. Markets know it, politicians know it, and now even insiders are sounding the alarm. For crypto, the next 12 months could be the most explosive period yet, as what unfolds will impact every asset class on the planet. That's the latest warning from Raoul Pal, CEO of Real Vision. He believes the current business cycle will extend into late 2026, but getting there won't be easy. With over $9 trillion in debt coming due in the next year, central banks may have no choice but to inject massive liquidity back into the system. Pal refers to this as the Everything Code, a framework showing how demographics, debt, and productivity trap policymakers into a cycle of endless currency debasement. While traditional markets may struggle, crypto could thrive, as scarce digital assets tend to perform best when money itself is losing value. Stay tuned until the end of this video. Raoul Pal reveals why missing this cycle could be the most costly mistake of your lifetime. Cybercriminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
The key thing, I've been an investor for a long time, as has Julian, and we've run diversified portfolios. That's what we've been taught to run. We now believe that diversification is dead, and the best thing is hyper concentration, which goes against what many, many people will tell you, but will explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate to unfucking your future, plus you need to add inflation. Yes, it's in addition to this, because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this, 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great, but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector's been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was Debt, Demographics, and Deflation. And that has been my framework ever since. So let's understand demographics. The US birth rate per 1,000 people has been collapsing over time. It is more pronounced in other nations. It's definitely more pronounced in Europe, China, Japan. So the Western world has basically the same issue, which is the growth of population, which drives GDP, has been falling. And that means that we can forecast into the future because we know when people become labor force participation rate, or they become part of the labor force. Now, for some reason, it's a 16-year lead. Maybe you could shovel it and make it 18-year lead. But really what we find is that demographics are destiny. They forecast where the labor force participation rate is. The labor force participation rate is the key thing for economic activity. So what we've got ahead of us is a trend rate of labor force participation rate declining. And what this chart shows, this is like the most important chart of all of macro, and I've never seen it produced anywhere else ever, because I don't think people understand it. This is the chart of the labor force participation rate versus government percent of GDP inverted. So what it shows is trend rate of GDP is basically offsetting the labor force participation rate fall as the population ages out. That is why we have a debt problem. That is why government spending is so hard to manage. It's because we have this aging population. That is the key to everything, and it's only going to get worse because of this. So this suggests out into the future, debt keeps going up. Now, the economic singularity will change this at some point, but we've still got this collapse in the labor force participation rate to deal with into 2030. And that's going to drive massive increases in debt to GDP. You see, these are in perfect mega trends. The labor force participation rate is in a beautiful log regression channel, and we should just move towards the bottom of the channel and beyond in the coming years. And the reverse of that is the government debt percentage of GDP. You can see them pretty clearly, the trend. Now, the next thing that we found that nobody else has found is that Fed net liquidity, which is the use of the TGA, the balance sheet, and the reverse repo, has been the main mechanism for financing the debt. So they're joint at the hip. And so what they're doing is using liquidity to finance debt. If we do this on a globalized level, it's actually global total liquidity that is the real answer to all of this. But that you show how close that correlation is. Yes, the axes are different log scales, etc. But honestly, don't mid-curve it. This is the key thing. They're using the balance sheet plus any monetary tools possible, including the banking system, to pay for the interest on the debt. So you can see total global liquidity. They've started using the banking system as part of this. So that's why we've started switching our key measure to total liquidity, not Fed net liquidity, because it includes M2 and other measures. And you see what's happening there is it is starting to rise, as is the debt to GDP again. Now, what's interesting is when we look at the interest payments, you can see that it's the liquidity that pays the interest payments. The interest payments, because interest rates are above trend rate of GDP, that needs to get monetized because there's not enough economic activity. If the trend rate of the economy is, let's say, 2% and rates are at, let's say, 4%, well, that's double the amount of economic growth to pay the interest. We don't have it. The government's 100%, 120% in debt, and the private sector's the same. So there's just not enough economic activity to pay the interest on the debts. So this is why they debase currency. It's the story as old as the hills, but it is incredibly important to understand. Try not to mid-curve this and overanalyze this, because this is what is going on.
Raoul Pal argues that the old rules of investing are dead. Diversification no longer works when every asset is tied to central bank money printing. With fiat currencies quietly losing around 8% of their value each year and inflation on top, investors now need to earn roughly 11% just to stay even. That's why Pal advocates for hyper-concentration, focusing on assets that can outrun the system itself. His framework, the Everything Code, explains why. Demographics are shrinking, productivity is stalling, and governments are relying entirely on debt that's funded through liquidity creation. This process directly links global markets to central bank balance sheets, trapping the financial system in an endless cycle of money printing. Now, back to Raoul Pal's discussion.
As I said, it's not the first time it's happened. It's actually happened in the 1950s, and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time. And it's all driven by this one thing: the servicing of the debt. You see, back in 2009, well, 8, 9, every major government around the world gave themselves a debt jubilee. They paid zero interest on any debt, and most of the private sector got to zero interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles. So Bitcoin, some people thought it was the halving cycle. It's not. It's the debt refi cycle, because it happens in all assets, the NASDAQ, commodities, everything. And it's driven by this like spring, summer, fall, winter. And they're all corresponding to how much money they're printing at any one period of time. Winter's when they're not printing money, but the others are when they are. And so those are these economic seasons that we talk about. So recently we noticed that, hey, the ISM, and you've heard Julian and I not struggling, but trying to understand, okay, what's changed in our framework? Our job is to understand and double test our framework at all points. So when something major is changing, which was the ISM not fitting the 4-year perfect sine wave, we started thinking, what's going on here? The ISM is more subdued than it has been ever. And we found out that the debt had been moved in 2021-22 because interest rates went basically back to zero. They managed to extend the curve by issuing further out, and they extended the debt maturity from 4 and a bit years to 5.4 years, creating a new longer cycle. Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come on to that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes. The way I try and put this is it is the single most dominant macro variable we've ever had. Correct. This is what the everything code is about. It is so dominant that only 3% of the NASDAQ variability is based on other factors. Now, the NASDAQ and crypto are both in secular uptrends built by network adoption models, but 8% of that is entirely just the debasement. The rest, the excess returns on that, is the network adoption model. But this factor is so dominant and so important that it's all that really matters. And that's why Julian and I keep saying everything else is noise.
Yep. So we'll keep going. And here's just another way of kind of visualizing that data, right? Here's our GMI total liquidity index again versus Bitcoin. You can see when it breaks out and moves higher. This is typically a good situation for risk assets, Bitcoin included. Obviously, the exception was COVID back in 2020, which I highlighted very clearly. But the point is this index is still rising. And then when we talk about global M2, and Raoul had discussed this on Drinks yesterday, yes, there's been a gap that's opened up, and that's pretty evident here.
The system is running out of road. When interest rates stay higher than the economy's growth rate, there's simply not enough economic activity to service the mountain of debt naturally. This leaves governments with only one option: monetization. They print money to cover the interest. Since 2008, this has triggered what Raoul Pal calls ultra-liquidity waves, powerful four-year cycles that shape every major asset class. Stocks, commodities, and Bitcoin have all risen and fallen in rhythm with this liquidity tide. The last refinancing cycle between 2021 and 2022 extended debt maturities, pushing the peak into late 2026. While that move bought some time, it also intensified the pressure. Over the next 12 months, nearly $9 trillion in debt is set to roll over, making aggressive money printing all but inevitable. History shows that when liquidity floods the system, scarce assets soak up the capital. And in this coming wave, crypto stands as the ultimate beneficiary, not just as a trade, but as a survival strategy in a world where fiat currencies lose value year after year. The only question now is, who will be positioned before the wave hits? Will you be ready for what could become the largest wealth transfer in modern history, or will you be left holding assets that melt away against the tide of liquidity? For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.